Welcome back to our last lesson for fixed income markets. Thus far, we've mentioned a range of funding sources for companies. They include bank loans, commercial paper, notes, and bonds. Financial institutions such as banks have larger financing needs than non-financial companies because of the nature of their operations. In this lesson, we shall discuss the additional funding alternatives that are available to banks. The majority of these funding alternatives have short maturities. These are retail deposits, certificates of deposits, reserve funds, and interbank funds. We shall also learn what repurchase agreements are, more commonly known as repos, as a funding source for banks and other market participants. Let's begin. You probably have some experience putting your money in a bank. A bank holds deposits for individuals like you and also commercial depositors. All these deposits are known as retail deposits. There are several types of retail deposit accounts. Checking accounts provide the highest level of transactional convenience and immediate availability of funds, but typically pay no interest. In contrast, savings accounts provide a lower level of transactional convenience, but they do pay interest. Money market accounts were originally designed to compete with money market mutual funds. Depositors can access funds at short or no notice, and they offer money market rates of return. Thus, money market accounts are for depositors an intermediate between checking accounts and savings accounts. Besides retail deposits, banks also obtain funds from the wholesale market. One common way to do so is to issue certificates of deposit. A certificate of deposit is an interest-bearing security that matures on specific dates and is offered in a range of short-term maturities in the wholesale market. Most CDs have maturities shorter than 1 year and pay interest at maturity. CDs with longer maturities are called term CDs. They can be issued in varying denominations. Large denomination CDs, typically $1 million or more, are an important funding source for banks. A CD may take one of two forms, non-negotiable or negotiable. If the CD is non-negotiable, the deposit plus the interest are paid only to the initial depositor at maturity. A withdrawal penalty is imposed if the depositor withdraws funds prior to the maturity date. Negotiable certificates of deposit can be sold. They typically have maturities of 1 year or less and are traded in domestic bond markets as well as in the Eurobond market. The third alternative source of funding for banks that we're going to discuss is reserve funds. Before that, let's have a snippet of bank regulations. Many countries require banks to place a reserve balance with the national central bank. The reserve funds help to ensure sufficient liquidity should depositors require withdrawal of funds. Should the reserve balance for a bank fall short, most countries allow that bank to borrow from the central bank's reserve funds. The interest that the central bank charges on reserve funds varies among countries, from a low interest payment to no interest payment, to charges for keeping reserve funds. Another option for banks is to borrow from the reserve balance of other banks. Some banks have an excess over the minimum required funds to be held in reserve. In the central bank funds market, banks that have a surplus of funds are allowed to loan their excesses to banks that need funds for maturities of up to 1 year. These funds are known as central bank funds. They're called overnight funds when the maturity is 1 day, and term funds when the maturity ranges from 2 days to 1 year. The interest rates at which central bank funds are bought and sold are termed the central bank funds rates. The rates are determined by the markets, but influenced by the central bank's open market operations. In the United States, the central bank funds rate is called the Fed funds rate, and this rate influences the interest rates of many short-term debt securities. Other than reserves on deposit with the central bank, funds that are loaned by one bank to another are referred to as interbank funds. Interbank funds are loaned between banks for periods of 1 day to a year. These loans are unsecured and, as with many debt markets, liquidity may decrease severely during times of systemic financial distress. Repurchase agreements are another important source of funding not only for banks, but also for other market participants. A repurchase agreement, or repo, is an arrangement by which one party sells a security to a counterparty with a commitment to buy it back at a later date at a specified price. So in effect, the buyer is actually lending funds to the seller with a security as collateral. On the repurchase date, the seller, which is the borrower, is supposed to pay the lender the repurchase price in order to obtain back collateral security. A repo for one day is called an overnight repo, while an agreement covering a longer period is called a term repo. The repurchase price is greater than the selling price and accounts for the interest charged by the buyer. The interest rate implied is called the repo rate, which is the annualized percentage difference between the repurchase and selling prices. Repos are popular because the interest cost of a repo is usually less than the rate on bank loans or other short-term borrowing. Let's look at an example. A firm named Borrower enters into a repo agreement to sell a 5% 10-year bond with a par value of $1 million. The bond has a current market value of $950,000. The bond is to be sold at $920,000 and repurchased 180 days later for $932,000. The holding period yield for the 180-day loan period is 1.3%. The repo rate would be expressed as the equivalent annual rate, which is 2.63%. So, what are the factors that affect the repo rate? Firstly, like most other debt securities, the longer the term, the higher the repo rate. Unlike other debt securities, the credit quality of the borrower is not that important. Instead, the credit quality of the collateral is much more important. The higher the credit quality, the lower the repo rate. Borrowers have the choice of whether to deliver the collateral to the lender or just pledge the collateral without delivery. If the collateral is delivered, the repo rate will be lower. And because there are alternative sources like taking a bank loan, the interest rate charged by these alternative sources is also a factor. If alternative interest rates are high, the repo rate is likely to be high as well. Now, back to our example. Repurchase agreements, like any other form of debt instruments, are not without credit risk to the lender. The counterparty can default, which in this case is if the borrower fails to repurchase the collateral on the repurchase date. The compensation to the lender is that she can take possession of the collateral. The risk, however, is that the price of the collateral may have fallen following the inception of the repurchase agreement, causing the market value of the collateral to be lower than the unpaid repurchase price. This is the reason why you see that there's a gap between the market value of the collateral and the selling price of the collateral. This gap is known as the repo margin or haircut, which in this case is 3.16%. The repo margin provides the lender a margin of safety if the collateral's market value declines. Again, let's examine some of the factors that affect the repo margin. Similar to the repo rate, the repo margin is affected by the length of the repurchase agreement. The longer the term, the higher the repo margin. Also, the quality of the collateral is important. The higher the quality of the collateral, the lower the repo margin. Besides quality, the supply and demand conditions of the collateral also matter. Repo margins are lower if the collateral is in short supply or if there's a high demand for it. This is because some lenders want to own a specific bond as collateral. They compete by offering a lower repo margin. And lastly, the credit quality of the counterparty. The higher the creditworthiness of the counterparty, the lower the repo margin required. So in summary, a repo is an agreement whereby one party borrows cash by selling a collateral security and promises to buy it back at a specified future date at a specified price. Interest paid is implicit in the repurchase price. You may, however, come across this term, reverse repurchase agreement. This essentially is the same agreement but viewed from the standpoint of the lender. From her standpoint, she lends cash by buying the collateral security. On the repurchase date, she sells it back and earns interest in the process. So in essence, the question of whether a particular transaction is labelled a repurchase agreement or a reverse repurchase agreement depends on one's point of view. And that concludes this lesson on short-term fundings for banks and this topic on fixed income markets. In our next topic, we shall move on to valuation of fixed income.